Hello, and welcome to the Incorporate podcast, a podcast for business owners presented by the UB Center for Entrepreneurial Leadership. I'm Susan Steffan. I'll be your host for this podcast. Joining me is Jordan Lema. He is the head of Lemur Studios, and he will be our producer. And Alan Pawlowski of Pace Management. He's our guest today, where we'll be discussing the issue of enterprise value and how business valuation works. So welcome, Alan. Nice to have you with us.
Susan, thank you for having me.
Yeah. So can we start off and tell me just a little bit, what factors, well, first let's introduce yourself. Tell me a little bit about who you are and what your company does.
Pace Management is a mergers and acquisitions company. We facilitate both buy-side and sell-side transactions. We've been doing it for about 20 years. And it's a national/international type of market for any kind of transactions, buy-side and sell-side. And we do almost all industries. Most of the people that do what I do are generalists, so we fall into that category.
Nice. So you've probably seen a lot of deals in those 20 years that you've been doing this kind of thing. So tell us a little bit, for the business owners listening, what are the key factors that drive business valuation?
Great question. So the big number one thing that drives business value is if the business owner is the business, there is no business value. You really want to work in your business to grow yourself out of being necessary to the operations of your business. Anybody that looks to acquire the business, if you think about it, if they see the seller as the key point from an operational sales, whatever perspective point of view, as instrumental, how do you transact that business? So first and foremost, for any entrepreneur, if you're not already there, you should be working yourself out of the necessity of being in day-to-day and more of an executive oversight type of role. That is first and foremost and hugely important. I've had many businesses come to me and try to sell and say, oh, you're just a little bit too tight. You've got to grow a little bit, get some more staff, get some more depth and breadth on your bench, and work yourself out of having to work there day-to-day. Lesser issues, there's a myriad of issues, Susan, when you ask that question, but I'll talk about some of the higher points. Another issue for business valuation, or the sellability, literally the sellability, can I sell my business, is a concentration of customer risk, or any kind of concentration of risk, concentration of supplier risk, concentration of customer risk. You need a relatively diverse supplier and customer or subcontractor type of format to your business. So if one of the legs in the stool go away for the new owner, the business doesn't collapse. The thing to think about from a buyer's perspective is that when they're buying something, they're buying a certain amount of risk. And anything that's going to mitigate risk is going to drive value and sellability. Anything that's any concentration of risk will deter sellability and business valuation.
So if you're a business owner that's not planning to sell anytime soon, why is it important to even worry about your business value?
Well, I think business value and the valuation is a great way to benchmark your performance in the business. Let's say numbers meaning nothing, your business is worth $1 million this year. Do a valuation, standard valuation methodology. You do it again next year and your business is worth $1.2 million. That's a 20% return on investment in your business for your energies, your efforts, your capital, your resources. You can now measure your business against traditional markets and traditional returns on investment. It's really a great performance indicator.
Oh, so you can really use that to measure the effectiveness of whatever it is you have in place, your
decision-making,
your marketing, your decision
strategy.
Making.
Exactly.
Now, you've referred to yourself as a generalist. What are some of the areas that you've helped to sell a business in? So just, I'm sure it covers a pretty broad spectrum, but for the listeners at home, like what kind of business are we talking about?
It's probably easier to say what we don't do. Retail and hospitality are both very challenging businesses. And there's a narrow channel of specialists that really handle those types of markets. And any business that doesn't have really a balance sheet, retail and hospitality, same rules apply. It's really hard to transact value, other than maybe customer lists and some lesser value drivers. Anything but retail and hospitality, we've pretty much touched. We've touched a lot of different industries over the years.
So when business owners are looking to track their enterprise value, you talked about it like having a valuation number, but assuming they don't always do a full valuation, what are the best financial indicators that they should be looking at to kind of get an idea in between doing a valuation whether they're driving value?
Size matters. You can use that if you want. Your earnings is really what's going to drive any kind of valuation. Again, going back to the risk model, when somebody wants to buy your business, they're buying cash flow, right? They're buying profits. So they want some sustainability and scalability of those profits. So you want a profitable business, but a scalable business as well. If we buy, again, that same $1 million business, the buyer would in 3 years, hopefully it's worth $2 million by different tweaks and adjustments and additions they would make to that purchase. All buyers want to scale and improve upon the acquisitions that they're making.
So a buyer isn't buying the business to make what you make. They're buying the business to hopefully make more than what you make through the combination.
For the most part, yes. I mean, there's statistical curves, right? Most buyers are strategic buyers that are trying to combine resources with their resources. If I sell this widget and I buy this other business with a complementary customer list or service or product offering, now I can combine two and cross-sell across both of my businesses. So there's synergy and strategy there. If I want to go buy Jordan's business tomorrow, I don't know anything about this business. I might be happy with what the returns on investment are and the cash flows that are produced. But that would be a financial buyer, not a strategic buyer. Most of our business is with strategic buyers. And anybody trying to get maximum enterprise value for their sale would want a strategic buyer as well.
What are some of the common mistakes that business owners make when they're looking at the value of their business?
Great question. Not knowing the valuation methodology for their business. I've seen a lot of business owners come to me and look at their balance sheet and they say, well, net book value, assets minus liabilities is what my business is worth. And it's one of the farthest things from the truth. Each industry may have its own unique valuation methodology, a multiple of sales, a multiple of earnings, 1 times residual book of business over 3 years. Knowing your business's valuation methodology, it's industry specific for the most part. And then what are the value drivers within that? Is it the size of my customer list? Is it the size of my reoccurring revenue, which is really common? Things like that.
So it sounds like there's some commonalities that a business owner, regardless of what industry they're in, things they can do to make their business more valuable, right?
Absolutely.
We've kind of talked about management and operation. So if you're a business owner listening to this and you think, I haven't really thought about this before, I kind of am the business right now, like what steps would they need to take to start working towards increasing their value?
So a lot of small businesses grow to medium businesses organically, and eventually the entrepreneur works themselves out of a job. It needs to be planned, right? The entrepreneur needs to think about the steps it's going to take to get them out of being the operational sales production necessary body in the building to an oversight and non-essential component to the business. It takes a plan. The UB CEL program, core and mastery programs are excellent facilitators of providing a strategy and an execution shepherding to get the entrepreneurs past necessity in their business, driving enterprise value.
So I am exactly that business where, I'm the owner and I am the business. It was someone that was a business partner, not a partner in a business. I'm sorry, I should rephrase that. Someone I do business with actively that wanted to buy into Lema Studios or buy Lema Studios. They would know it's just me. They know that, not just me, I have people, but they know that I am that integral part. Why would they want to buy the business knowing that? Or is that maybe a bad play on their side?
No, it's a great question. And it gets a little deep, but they probably would want to buy most of your business and not all of your business. They'd probably buy 70% of your business and you'd have, it's called trailing equity going forward in the new entity. They'd combine forces and rely on you to be a component in that. Many times private equity buyers, when they buy strategic acquisitions, they do trailing equity because the business owner hasn't fully eliminated their necessity to be in the operations. So when somebody comes to you and they know you're part of the integral operations, they're probably anticipating you staying along. It's not, we're going to give you a big check, you're going to walk away. There's some kind of a post-closing relationship or marriage to be had.
Well, you're definitely heard, though, about making yourself less important to the business, because that will just make my life better as time goes on.
100%.
Anyway.
100%.
Yes. Yeah.
That's not a bad thing.
The other follow-up to that, though, is, and it could be a scam. It could be, I don't know. I get like quarterly emails. Someone reaches out via email, we're interested in buying your business. I don't even respond. Is that a scam people should be aware of?
Far more often than not, they're legitimate, believe it or not. Snail mail is almost 100% legitimate. E-solicitations, it's a jump ball. What I would suggest first is just Google who it is, right? It's going to come up as an investment bank or M&A firm like ourselves. You can research it pretty quickly whether it's a legitimate solicitor. We do exactly that when we're going for our client that would be a buyer and they want to buy things, we do research, we buy and create lists, we do outbound digital and snail marketing, and there's a conversion rate on all of that kind of stuff. But very quickly, they can legitimately see that, yes, we're an entity, right? These guys are really M&A advisors. They can do this stuff. So if you're interested, you should just check it out, do a little bit of due diligence. But I have a bigger response to that question, is if you do decide to go down that road, any of the people that I represent on the sell side, I tell them never negotiate with one buyer. You want to run a process where you're talking to multiple buyers when that day comes. So I would say, do not respond. Satisfy your curiosity by checking if it's real or not, but do not respond until you talk to somebody and decide to go down the sale road and create the process. And that's attacking multiple potential buyers, creating a bidding process, an emotional component to that bidding process, ultimately driving up the deal structure and the deal value. And I always tell my clients, the price is in the top 5 most important things in a deal, but it's not in the top 3. Structure is number 1, culture is number 2. 3 is a jump ball depending on what the industries are. But I can go on and on about that, but I'll probably leave that.
No, that's great advice. Thank you so much.
But it does make sense that you want, if somebody's reaching out to buy you, other people might be interested in it as well, and you may as well kind of explore what that looks like. I hadn't really thought about that.
And drive up the sale price.
And drive up the sale price.
Or more stock. If there's some trailing equity, maybe they would have offered you 20% equity, but somebody else is looking at them. We better offer them 30% equity, right? Things like that. It drives the structure as much as the price.
So what are some of the mistakes that a business owner makes when they get involved in this process? What do they do that makes your job harder or makes it harder for them to get a good deal?
Yep. Exactly what I just said before. Mano a mano. We do not want any kind of one-on-one sell side negotiations. Flipping the script on the buy side, you don't want to buy anything that's on the market, right? The M&A facilitator or the investment bank should create lists of businesses or strategic acquisitions that aren't readily for sale, because we want to have that one-on-one conversation, not driving the value up. Yeah. Reverse exactly what I just said for the buy side process, but run the process.
Is there even a world where someone does a buy or a sale without engaging the help of someone like you? I mean, I could imagine not knowing anything of what to do to sell a business without your help. I mean, do people make that mistake where they try to do it alone?
Oh, absolutely. And suppliers, there's many people, horizontal and vertical, supply chains and integration with the business that have relationships, and businesses transact like that all the time. So if I'm selling my business without the help of others, I would almost guarantee that you're not going to maximize your enterprise value, and you may not maximize the structure. It takes a village to do a deal. You have an M&A attorney, you have an M&A accountant, you have a tax accountant, maybe the same, maybe different, depending on the deal. You should have an insurance person, an investment person, and an M&A advisor. And generally in the industry, we're considered the quarterbacks of the deal. We keep all the different pieces working to their function, but also moving the deal downstream from inception to closing table. So it's super important to have the right team, and to do it without an advisor. You're just not going to advisor myself, an advisor from the team point of view. You're not going to maximize the value. And also on the buy side, you might be overpaying for something by not running the process. It can be done all day. You're just not maximizing dollars or structure. Does that answer it?
Yes. Okay. What other mistakes do people make?
The big thing is not engaging professional help. And the number one reason deals don't get across the finish line is somebody not engaging somebody to facilitate, or even more common is when you hire your cousin, Susan, no pun intended, the real estate attorney to try to do a transaction for a closing. It's an apple and an orange. You don't go to a cardiologist for a broken leg, right? You don't go to a real estate attorney for a transaction. You don't go to a tax accountant for a transaction. Picking your professional team is the number one reason deals don't get done across the finish line, or deals are done incorrectly. So that's super, super important.
Do you find that a lot of the business owners are somewhat disillusioned in the value that they're expecting?
Oh, yeah.
Is that an issue?
I think it's worth a lot more.
Oh, yeah.
Again, if the business owner has a going awareness of their business valuation, and it's a range, there's no hard number in a valuation, right? But if they have an idea, if it's a $5 million business or an $8 million business, there's usually not sticker shock when you go to market. And if there is, if you have running the process, you have multiple data points to reference, right? We have 3 bidders, they're all in this range and you're down here, right? Or you're up here. You can have credible conversations, again, by running the process when there's a misunderstanding, maybe not disillusionment, this misunderstanding of what their enterprise value is in the marketplace.
I'm guessing most people overvalue themselves? Or?
Yeah, pretty much, yeah.
Okay.
I had somebody a couple of months ago came in and said, if somebody offers me $8 million for my business, I'll sell it tomorrow. Did a quick valuation, it was like 3.8, 3.9. We're almost 100% off the mark. And
I'd sell tomorrow.
That's an interesting conversation, but having that reality, we won't start the train leaving the station without at least a relative understanding of what the market will probably support for a business. Just wasting time and money by doing that, right?
So, Alan, because you made me think of something. Let's talk for a second about businesses that aren't in the idea of a sale process, but they might be a family business where it's going from one generation to the other, and maybe there's paperwork that has to go along with that to either buy out dad or grandpa or mom or whatever's happening. How does valuation play in to non-sale areas of a business?
So we do a market valuation looking for sort of like real property comps or similar data that supports what the market is buying and selling for in various businesses. There's a certified valuation license. Mostly CPAs have it. But the certified valuation is not necessarily representative of market valuation. Certifieds many times are based on future cash flows of the business, and market valuations are almost universally based on historic performance of the business. Those listeners out there might completely disagree with that, but that's my 20 years of experience speaking to valuations. But you need a CVA, certified valuation analysis of your business for estates, trusts, wills, divorces, anything that in front of a court of law, they need a stake in the ground valuation of the business. A CVA is very appropriate. They're far more expensive than a market valuation. And a market valuation is only that, it's a rough guess. We don't know what the market's going to pay for your business until we take it to the market. So spending the extra money on the CVA, if not legally required, we always advise is probably not the best use of your funds.
So it's kind of like if I'm selling my house and I get an assessed value of my house or an appraised value of my house versus what it actually sells for. They can be very different.
100%.
Yeah.
Most people selling their home talk to the realtor. What's my house worth?
Right.
They don't even go to an appraiser and spend $1,000 or whatever it is.
So bringing in a little bit of layperson to this conversation, what's what would you say is the difference between Shark Tank and reality? What's the major takeaway between real business sale and what people see on TV and fantasize about?
Shark Tank's real. I mean, I watch Shark Tank and the metrics and criteria and proposals are very sophisticated transactional topics.
Do you recommend people having a song or an act when they're trying to sell their business? Going in and
it's
rapping?
a great question.
Okay.
We do a deck, 10 to 30 pages when we're selling a business.
Okay.
And a lot of the presentation, after signing a non-disclosure, we put it out to the would-be interested market. But a lot of the interest that we get is based on the story as much as the financials and or pictures. But we are heavy, as the market and the industry is, in telling the story of the business. Where did it come from? How did it grow? Where's it at now? What's the future potential? Why is the business owner leaving? So it's a two-dimensional song and dance, but there's absolutely a storytelling and sales component to transacting any kind of business.
Well, there's hope for me because I have a great backstory, which I'll spare everyone today, but that's going to add to my value.
I'd love to hear it.
It's another time.
All right.
So, Alan, I want to talk for a minute about, so let's say one of our listeners is, 30-year-old who's got a business they've started for the last 5-6 years and it's doing well. They're not thinking sale. They're not thinking retirement. They're not thinking turn. What do they need to know? Why is understanding their potential exit important at this stage when they're very early and they're growing? What is a person who thinks this doesn't apply to them yet? Why does it, and what should they be doing now?
Great question. So professional buyers, private equity, venture capital, angel investors, all have the end figured out before they even look at the beginning. And I always advise all of my clients to know how you're getting out before you get in when you're buying a business. The private equity model is a classic 5-year buy it, scale it X% by this kind of synergy creation, and then flip to the next level of private equity. The same rules apply from the professional investing world to the small and medium-sized entrepreneur. You should know how you're getting out. You should have certain expectations of performance. You should have certain expectations of future value. This is your roadmap to success for the business and for yourself personally. So knowing how you get out before you get in is one of the first questions I ask. And I think it's critical for somebody to contemplate that before they get in. My businesses when I was younger, 100%, I had no idea how I was getting out. Just got in the business. Let's make some money, right? But that is not the best way to do it for sure.
Right. And for a lot of our business owners, their personal value is the value of the business. So they don't necessarily have a 401k unless they've established one through their company. Probably a lot of their assets, a lot of their mental energy is all tied up in the business. So the business valuation is really I think a testament to their personal value as well. And maybe the two being so intertwined, if something goes wrong with the business, then, you know, now we're talking about food on the table kind of thing.
Totally agree.
Yeah.
In the $0 to $5 million value businesses, a recent periodical put out that 60% of the entrepreneur's net worth is usually tied up in the business. And that percentage decreases as the business gets bigger, which sort of makes sense. You're drawing capital out of the business as the business grows. But what I advise, again, I said this earlier, one of the professionals you need at the table is your investment advisor. So you know, is out of my personal balance sheet, my personal portfolio, this business really 60% of my net worth? And what do I need to get for the sale of my business to later in life sail off into the sunset or get an appropriate return on investment? These are all decisions that the seller should be front of brain on when they're making a decision to go to market. Somebody may be able to sell that same business, that $8 million for $3 million bucks, but they need $5 million for their personal portfolio to live the same kind of lifestyle they expect in later years in life. Not connecting the business valuation with your personal balance sheet is a huge mistake. And again, commonly not done in the 0 to 5. More often done 5 to 15, very commonly done 15 and up.
Yeah. Well, and we talked a little bit about the fact that if you are your business and you're the one working, 24/7 in the business, that it's very tough to assign a value to that because if you walk away, the business stops. So who's going to buy a business that if you're not there isn't worth anything? But I want to touch for a second how that plays out in terms of the kind of estate planning or life planning, because if you are the business and something happens to you and you maybe haven't started what we're talking about, working yourself out of the business, that business valuation could impact a whole lot of things, right? Your employees, your family. So I guess what you mentioned a estate, planner or some kind of financial advisor. Well, how should people be thinking about their role in the company and how that impacts, I guess, their family wealth?
Same rules apply. You need to work yourself away from the business and maximize enterprise value. There's a hybrid model like Jordan and I were talking about recently that maybe there's trailing equity and you have a 3-year transition plan. You're going to get some capital now. You get majority bought out. The business is going to grow. You're actually going to get a bigger slug of money downstream, theoretically. And then that helps support your balance sheet. But knowing that number is critical. And then if you know you're not going to make it, then you have to adjust things, right? But you can't say I need numbers meaning nothing. $500,000 a year cash flow for my investment portfolio, and it's only going to be 2. Okay, well, you got to change your lifestyle and your life plans because the reality is the business is not going to support the $500,000 a year when we sell it.
Yeah. And if you're a business owner who's starting to work on these things that we're talking about to build enterprise value, they're building a team that can operate the business when they're off for 2 weeks on vacation. They're doing some standard operating procedures. They're diversifying their customer base, doing all, making sure somebody else can be the rainmaker, doing all of that. Not only is it going to help raise their enterprise value, but it's going to mitigate the risk of if something happens to them. If they get an unexpected medical issue or something happens and the business can still run, then maybe their family can still be taken care of or them, depending on the situation. So enterprise value comes into play for a lot of people, regardless of whether they ever sell their business or not.
It does. It's a great benchmark, and it gives a lot of, I love what I said at the very beginning. It's a great performance indicator, but it also puts in the context that 60% in their personal balance sheet. What is my net worth? Do I have to keep working or can I call it quits today? These are big decisions for later in life entrepreneurs. But put those pieces together, sort out systems, process, people early on when you're an early entrepreneur, and understand what the bigger picture looks like. And I think that's a very powerful tool in the toolbox.
Well, it's kind of like financial planners always tell people in their 20s to start putting into that 401k plan so that it can grow.
50, yeah.
Now
right.
you want the young business owner to start, building the system so that it can, same thing, exponentially grow the value of their business.
Think about the end, how you're getting out before you get in, and what this business needs to look like when you get out. And those are all the things: diversification, earnings, staff, systems, process, people, technology, all those things.
That's just generally a good tip, even if you're not trying to sell your business, though, because 100%. The more the business is not dependent on you, the stronger it will be. And that's something I learned pretty early on in the CEO program. I haven't been able to put it into play all the way, but taking steps towards that is really important for growth. And I think anyone could benefit from that, even if they're not really.
Totally agree, Jordan. Totally agree. The worst case scenario is your income statement looks a little better. Even
right.
if you don't sell it, right?
Right.
And who's going to argue with that?
Yeah. How is the business valuation and what's going on in the world of mergers and acquisitions changing maybe the next 5 to 10 years?
So what we're seeing, the big change that's happening is private equity used to have $100 million basement for valuations where they look to consolidate businesses. Middle teens, it dropped to maybe 50 million. We have private equity now ducking below 20 million on deals that we're selling and actually bidding on things. So it's amazing that private equity, professional buying groups building accretive value are going that small into the market. And if you think about private equity as an industry, they're running out of acquisitions. They're running out of things to return investment on their portfolio members. So I think we're going to see a lot more private equity at small and mid-sized deals where private equity was sort of esoteric and it's not a real thing. I think it's going to be in all of our conversations. Anything with a business valuation above $10 million, I think private equity might be a component within the next couple of years.
So a lot more opportunities for smaller businesses if they so choose. On the sell side,
yeah, absolutely. If you're looking to buy and grow strategically, sooner's better than later.
Because you've got competitors coming.
You've got very sophisticated competitors coming into your swimming pool and trying to gobble up your competition, which could directly affect your landscape. There are different operating techniques, secrets, practices, et cetera.
Okay. Well, markets have been a little turbulent of late, to make an understatement. So what kind of advice would you give to business owners that are looking to implement some of these valuation, value producing activities in kind of uncertain times?
Yep. So advice I give to, this is what I follow and I give to anybody that'll listen. You have to gauge investing in yourself, right? Your business, like I mentioned earlier, you can measure the return on investment by knowing your valuation. You have to have a personal opinion of, is my treasure, my time, my capital worth putting in my own business or into some third-party investment mechanism? Everybody has a different risk tolerance. That's the universal differentiator in human beings, is risk tolerance and acceptance and deterrence. And if people are in these crazy times, do you buy precious metals? Do you double down because the market's cheap? Do you invest in your own business? These are all investment decisions, but I always feel investing in yourself is a good idea because I control my destiny based on me getting up every morning and doing what I want to do, not handing it off to a third party. Clearly, a diversified portfolio makes the most sense in all of this. But when you talk about these crazy times and how does it affect my perspective on business owners, I would think not once or twice, but probably 3 times about, do I double down on my own business and insulate myself from outside activities before I just go to traditional markets for investing?
Interesting. So part
my
of
2 cents.
Right. Part of investing in themselves might be to, again, hire that good team, but also to upskill themselves to help the business do better in the future. If
I'm a $10 million business, I want to be a $20 million business. I can buy another $10 million business. And in a closing with cash flows that many times support that acquisition. Or I can grow my $10 million business 1 employee at a time, 1 customer at a time, organically.
With a lot less
Most
risk.
Businesses, larger businesses, are perpetually doing both. They're always looking for acquisitions and they're always growing organically. But to grow your business strategically through acquisitions, it's compelling. But a word to people that are listening is anybody sub $5 million in enterprise value might think it's too sophisticated to do a deal, or we can't afford to do a deal. Deals come down to structure. Many times deals are done with zero or very little cash at closing. It really becomes a willing buyer and seller getting together. So for those that want to listen, if you're thinking about growing strategically, consider it, because it's not as black box mysterious as most people think. It's amazing. Oh, I can't do that. We're only a $5 million business. Contrarily, you can, and it's a good strategy.
What are the ins and outs of that, and how can that work for you? I mean, I feel like at this point in my career, I'm not sure I have the funds to do that, but there's some strategic relationships that could be formed by a competitor. How does that work?
Great question. It doesn't have to be big or sexy, and you don't need a lot of resources, i.e. an acquisition team. For smaller or medium-sized deals, you would approach a competitor and just propose, how about we join forces? The upside for you is you might get some staff, you might get a customer list, you might get some equipment. Sometimes the entrepreneur on the other side doesn't really want to be an entrepreneur anymore. People start into business like, well, I want to be in business. All of a sudden they get into business like, this isn't as sexy as I thought it was going to be. Those are great acquisitions. And you don't need a big team or a lot of expense to do that. And many times for 10%, 10 cents on a dollar, there's a lot of SBA financing out there that's readily available. And again, through structure, a good structure, you can get it to $0 needed to close a deal, other than legal expense that you would need to close a deal. But I think growth through acquisition, again, if that person has one person, which was the owner, becomes a foreman with 4 people below them, you've just got 5 hires. If they had a customer list of 100 clients, you just got 100 clients and maybe some equipment and cash flows. It's that easy.
And for some people that would be selling, it could be a major relief for them, you're saying, because it's something they're not managing well or don't want to be.
I am so sick of HR. I am so sick of insurance. We hear that all the time. It's thank God you called.
Well, and
Literally.
It does speak to the importance of keeping up your networking within your industry as well as across, so that maybe you have those relationships so that if someone's thinking I might not want to do this anymore, then you're top of mind for that conversation. So
I had a roofing contractor come to me. We had this exact discussion on retain you. I said, you don't need to retain me. For your targets, you do this yourself. And what my advice to him was go to your roofing suppliers. I think there's 3 of them. And tell your head salespeople that you're looking to buy the guys that are 30, 60, or 90 days late on their payables. Those are the guys that they're in distress in some way. They might be really encouraged to take that phone call for acquisition. So networking to your supply chain, networking to your customers, just knowing your industry and your competition, there are always opportunities out there. It's going to be about the structure, but there's always opportunities out there.
Interesting. So there's opportunities for creating the kind of future you want. If you are the entrepreneur who maybe would prefer not to be, you can still stay in the business.
Everybody wants the big chair until they get in the big chair, right? And it's like, this big chair is so comfy.
It gets a little scary sometimes. Oh, well, this has been awesome. Do you have any other?
This is fantastic. I always like it when I'm writing more notes about my business than about problems in the podcast. So thank you very, very much.
My pleasure. Reach out anytime. Glad to talk offline with you.
My takeaway is that your services are very important when entering into something this huge. And also, to make your business the best it can be, to really work on getting yourself not to be, the center of it, to have it be functioning without you for a sale. Those are my key takeaways, and that's what I'll have to work on.
I could say the same about both of your businesses as well. We all do what we do. We all add value to the entrepreneurial community, and it's all good stuff, just different.
So the takeaway is, if you can't take a 2-week vacation without calling into your company, you've got some work to do on your business, right, to get that value up.
It might take years, but put a plan in place.
Right. At least be thinking about it.
Yep.
Well, this was wonderful. Thank you, Alan, for all your insight and for
me.
sharing the information with our business owners. We truly appreciate it.